what do you make of the dollar slide? Is this about DC or is it something else?
I think it's a mix of a lot of things. So you obviously have DC, what we've been calling, there's probably a Trump premium that's being built into the dollar. A lot of people talk about interest rate differentials, but what we've seen for the past 2 months is US dollar is basically trading below where it should be from interest rate differentials of the US versus the rest of the world on a 2 sigma move. So the US is creating this high level of discount around the US dollar, but I think it's also coming at the same time that you're getting better data out of European Union, you're getting better data outside of the rest of the world. And what we're seeing is a lot of the headline risk that people were focused on at the beginning of the year in Europe is now started subsiding. And Europe seems to be moving into a different stage. The economy is growing twice the level of potential GDP, seeing the same thing out of Japan. And what we're starting to see is like the negative tone for the US dollar is building up at the same time the US data surprises are moving lower.
Right, no, fair point. I mean, we were talking in break, like if what had happened in DC happened 6 weeks ago, 8 weeks ago, would we be seeing the same kind of stress in the dollar? Because we've had hard data kind of rolling over a bit, some of the soft data coming in light. IP was great yesterday, but nonetheless, there's that worry in the market as well.
Yeah, I think the focus has been on the buzzwords that people are talking about is the divergence in soft and hard data. And I think usually when those things get reconciled, soft data tends to move towards where the hard data is at. And we got some really bad hard data last week. We had retail sales have a big miss, and we also had inflation, which was a big miss. And I think that had caught a lot of people off guard. But the big issue with inflation is there's a lot of temporary factors in that report. You have essentially telecoms changing the way that they price out their business models, which created a huge downside move in inflation in the way that people have to pay for their cell phone services. So the way we're kind of looking at it is domestic prices in the U.S. are running well ahead of the Fed's target, unit labor costs, those kind of things.
Well, I'm glad you brought up inflation and also tying it back into Europe. So today we got a Eurozone CPI, right? So core 1.2%, German core 1.6%. That's still below U.S. core here. And as you pointed out, differentials should tell you the dollar is moving higher. So is that a cue to buy the dollar?
Yeah, the way we're looking at it, so we have a tactical view, strategic view. Our strategic view is we are sellers of U.S. dollar rallies. The way we're looking at it tactically is we have these models we look at that usually have about half-life of a month. We're looking at interest rate differentials, equity prices, risk appetite, those kind of things. All of the major European currencies are trading 2 sigmas from where they should be, the implied level on those models, which tells you there's a lot of euphoria around the story around Europe. There's a lot of, I think what we see is a lot of the Brexit stuff is essentially priced into the cake right now. But there is this big dollar discount, which is coming off the back of what we're seeing in Washington. But what I think you're also starting to see is there was pent-up appetite for people to start to move back into the European markets now that we got the benign outcome in the French elections. But the way we're looking at it over the next month, the next 6 weeks, the Fed is likely to go in June. We still think they're going to hike in September. We do have scope for balance sheet reduction towards the end of the year and the beginning of next year. So there is more waves of tightening of financial conditions in the U.S., which is usually generally beneficial for the dollar. And given how much pessimism has been built into it, and the other thing to add to it is the other models that we track when we try to look at where hedge funds are positioned, the entire hedge fund community for the proxies that we look at are short U.S. dollars. And so even anecdotally, we have conversations with clients. The conversation is everyone is long emerging markets. People are building positions back into Europe, and everyone is extremely pessimistic on the dollar. And for me, that's usually a signal when we start to see the technicals, the positioning, the valuation all move in one direction. Essentially, we're starting to say, when does the rubber band pop and when does the dollar start to rally again? And I think we're reaching that point. If you had 1 month tactical view on looking at FX, it's a good time to buy the dollar going into the Fed.